Chris Grisanti, how are you positioned right now?
Well, Tom, usually I'd be here to tell you that we're bottom fishing and looking for these great values of stocks that have been really hit hard in the travel and entertainment areas, but we're not. We're sticking with what we call margin protectors. In other words, we think this gets worse before it gets steadily better. And we think the market consensus of strong growth ahead, really almost in a straight line, is just not correct.
I look, Chris, at the headlines for PepsiCo, and the major item for me is the smartest people out there really looking to try to gauge the revenue shortfall, and it seems they did better than the revenue shortfall. Could that be a trend, a better trend?
I think so, Tom. I think in these second quarter earnings, I think companies, at least the smart ones, and Pepsi's one, have set expectations in such a way that they won't disappoint. Having said that, us analysts are not looking at these numbers. We're looking at the second half expectations. They're going to be saying, how are things going? And when you get a company like United Airlines saying they're going to lay off a third of their staff if things don't get better, that's what we're afraid of. And that's why we're sailing probably a little closer to shore right now.
Chris, 40% of S&P companies have withdrawn guidance. How much guidance do you think we're going to get out of this earnings season?
Well, Guy, that's a great question. I don't think a lot. I think you're hitting on the right thing there. But I do think what we'll get is a tone. Folks will either say we're seeing people back in the stores, or we're seeing our order book start to refill, or they'll say, they won't say negative things, but they'll say it's too early to tell, or we don't have any update from last time. And I would take that as a bad sign, frankly.
Okay. In terms of what we are watching, though, clearly, and I brought up Tesla just a moment ago, I'm trying to figure out how I position myself in tech going into this earnings season. I expect it's the only area where expectations remain really quite high. Is it going to be harder for tech to beat expectations versus any other sector in this reporting season?
Well, probably. You're right. Expectations are high, and in a really horrific environment, these stocks have done incredibly well. So it wouldn't surprise me to see some kind of pullback, even in the darlings like Amazon. But having said that, we think those are still the only places, or just a few of the only places, where you can bank on reliable revenue stability. So we're sticking there, Tom and Guy. And what we're saying is, yeah, you may have a bump because expectations are too high. But in the long term, what we're saying there is the next 6 to 12 months, that's the place where we see the most reliability. We don't see it in the classic areas of value that we would be usually attracted to,
right? Like
the beaten down bank selling at book value. Wow, those would be terrific investments usually, but we just don't have any feel yet for how the credit losses are going to mount, how the yield curve is going to play out. So we think it's just too early to bottom fish here.